All right, good morning. Good Tuesday morning ahead of Juneteenth. Uh, I know a lot of investors are going to be quite grateful for a midweek day off as the markets are closed on Juneteenth. So for those of you celebrating, of course, enjoy with friends and family. And we haven't done one of these state of the markets in some time. This will go out directly to our Finom group members first, and then probably on June 19th, we'll send it out to the general public. With that, calling this the state of the market going into the second half of 2024. This video is going to take some time, and I hope you have time to stick it out with me. Because we're going to go into some details about what the market's doing, what the economy's doing, what the Fed is doing, what the Fed has done. We're going to bounce around a lot. So we do have a lot to cover here. The first 6 months of the trading year is almost completely in the books. And my illustrious co-host, Brad Carter, has just shown up. He's late. Give him hell, folks. Give him hell. Hopefully he gets his mic resolved and his camera so he can tune in and join in some of the fun here. So the first thing I did want to discuss is kind of a reality of today that the media just doesn't want to accept. Most investors, economists, market watchers, they don't want to accept the facts. And the facts are, and while I leave this open to being questioned, the fact is, thank you, Brad. How we doing, sir?
Can you hear me?
I can hear
All
you.
right.
Well, I've already started recording, so, join in whenever you feel appropriate. The first topic we're talking about here is the Fed, kind of the state of the economy. Has the Fed, I'll ask you, do you think that the Fed has already pulled off a soft landing, or, because we're not in a recession, a no landing? What are your thoughts on that?
I think we've been in no landing for quite a while. Really, there's just no recessionary signals.
I I agree. Well, what are your thoughts on the fact that the yield curve hasn't been inverted now for more than 2 years? I mean, that's usually what a lot of folks consider to be a recession signal of sorts. The manufacturing PMIs below 50. The leading economic index 23 months in a row in negative territory. A lot of folks think those are, and historically have been, somewhat of recessionary signals. What do you say to all that?
Well, I think we've all learned a good lesson about signals.
Amen. That's perfect.
I mean,
Perfect.
they're important to pay attention to, but if you don't see other things falling in line with the signal, you got to go, hey, maybe false signal.
Yeah. Yeah. Is the market really this dumb? We've got all these types of recessionary signals, but we've been in I don't know what, a 20-month bull market now. And I think that's what you're referencing. The market can't be that stupid, you know?
Yeah, and all the other economic indicators are just, we're plodding forward. We're not. It's just
Yeah. I think that the biggest outlier here when it comes to assuaging the former recessionary signals is the fact that the unemployment rate is still a tick below 4%. Jobless claims have remained in the, let's call it 200 to 240,000 range, for basically the duration of the last 2-3 years. And consumers are still spending. We have retail sales at, basically all-time highs, inflation adjusted, and the backbone of the US economy is the consumer. It's 75% of GDP is what's the consumer doing. So
right.
yeah, while the yield curve is inverted, while the leading economic indicator index has been in negative territory for 23 straight months, and manufacturing has been in its own 2-year-long recession. That's not the economy, right? The yield curve's not the economy. Manufacturing is less than 15% of the economy. I mean, it makes me wonder why it hasn't come to pass yet that the conference board hasn't changed the components that make up the leading economic index, but we could probably rant on that for a good hour alone. So I'll rest my case there, folks. The recessionary signals that aren't, because the consumer's still strong, they're still spending, and the job market is still strong. You got jobs, you got a paycheck, you're going to spend the paycheck. I've been saying this forever and a day. That's the backbone of the economy. So, here, this chart I have been posting and, injecting into our macro market research reports periodically because, folks are of the wrong understanding when it comes to the notion of a soft landing. They think it's this very rare thing that's only happened, 3 times in the past, going back to 1965. But the reality is, if it wasn't for COVID, 2019, after the Fed hiked rates throughout 2018, would have been a fourth soft landing. So no, folks, soft landings are actually more frequent than you care to believe or the financial media cares to promote. They are a little bit more frequent, and I believe that the Fed has already pulled off a soft landing or a no landing situation here. And the data, let's just go by raw data. Forget my feelings, Brad. Forget your feelings on the matter. What does history, the data, actually tell us? Well, this chart right here, annotated going back to 1955, so the post-World War II era, shows us after Fed rate hiking and cutting periods, after the first rate hike, the average duration to a recession is 27 months. Folks, that would put us right here, right now. After the first rate hike was 27 months ago. Typically, on average, you would be in a recession as of the month of June here in 2024. I don't believe we're going to have a backdated recession in the near term. So I think it's safe to say, by this measure, we have at least a soft landing. What about since the last rate hike? So we got the first rate hike, the last rate hike, the distance to a recession, the average distance to a recession is 9 months. That means after the last rate hike, we should have been in a recession by April of this year. Most of you are well aware that come July, we will anniversary the last rate hike. So we will officially be 12 months beyond the last rate hike. By these two measures alone, we've achieved at least a soft landing. What about since the first rate cut? Well, we don't have a rate cut yet. But the average from a rate cut to recession is 3 months. So even by the data, folks, even by the data, and this is the unfortunate thing about what gets promoted in the media, the consensus data would have estimated that we already were in a recession, and since we're not, we've achieved the soft landing. So with that out of the way, and to your point, Brad, earlier, right? All the failed recession signals. Here's a post that I tweeted back in May out there on the X. failed recession signals to date, the yield curve inversion. This is the longest yield curve inversion in history, folks. And I know that there's other people out there that say, well, the pain starts once it uninverts. They're the same people that say the pain starts when it's inverted. Is there ever pain? Is there ever not pain for those people? Please don't get into that. So yield curve inversion, failed recession signal. We've already talked about the leading economic index, failed recession signal. There's a spread in the consumer confidence index as well that is often used. That's failed. What about money supply, right? We were negative. We had the deepest contraction in history in M2 supply back in going through 2022 into 2023. I thought that was a measure of liquidity for the market, for the economy. That's a failed recession signal. And by the way, M2 supply has finally actually ticked higher into positive territory. The budget deficit as a percent of nominal GDP, a lot of people like to use that as a recession signal. Well, that hasn't worked. An annual spike in CPI. I mean, historically, you get a big enough spike in CPI, that tends to deliver a recession. Failed. As we're now almost 80% of the spike in CPI has been erased. Crude oil percent gain on a year-over-year basis, historically, going back to the 1970s, if you get more than an 80% spike in crude oil, you go into a recession. Well, that didn't work this time either. 2 consecutive quarters of negative GDP. We had that Q1 and Q2 of 2022. No recession. When mom's meatloaf tastes like filet mignon, you know you're in a recession. For some of you, that didn't work either. So these are all the failed recession signals. I know that nobody likes to say, well, this time is different. But come on. Come on, people. Get out of your feelings and into reality. We've heard a lot. I mean, what is it? Every day in the trading room, we're watching YouTube videos from CNBC clips and Bloomberg and Yahoo Finance, Brad, where they talk about the market is too concentrated and only a handful of stocks are going up. Well, history tells us that's what a bull market does. These are the top 10 most highly concentrated years for the S&P 500, going back to 1984. 2023 was the second most highly concentrated market return year since 1984. What I'm demonstrating with our proprietary data here is the following year returns after these highly concentrated years. Look at these returns, folks. 26%, 12%, 20%. The average return the following 12 months is 14%. The median is 23%, and the positivity rate is 80%. 60% of the time, in the next year, the Russell would outperform the S&P 500. Only 1 year, folks, when you had a highly concentrated market, did you have a negative return, or twice, a negative return the following year. That was the 1999 into 2000, and of course, the great financial crisis in 2008. I don't think we're setting up for a great financial crisis, but this, in a sense, debunks the myth of these highly concentrated markets being a danger, to the market going forward and your portfolio. Any thoughts on this here, Brad?
Yeah. There's 2 things that I would look for if it would make a yellow flag go up for me. One, we're still at full employment.
Right. Yep.
We've stayed at full employment for probably longer than.
It's the longest period we've been at full employment since that one stretch in the 1960s. So yeah, I mean, we've been under 4% from I think 26 months, the unemployment rate. Under 4% for 26 months.
So if you see that tick above 4%, actually right now it kind of needs to, because I think that's the only thing that's going to get the Fed off the fence. But that's where I'd start watching it maybe. And then I hope the Fed they could be backing off interest rates right now, and they're just not. But if it gets above 4%, then it's time to at least, take a quarter off and watch it for a while. And I think that's what they're going to do. I'm looking for one cut this year.
Yeah, I would be in agreement with that. Now, so far as getting above 4% in that unemployment rate, and hearkening back to all the failed recessionary signal, do you think that's actually a good measure for this economy, for this labor market? Is that something we tick above 4%? Would you be concerned at that point? Maybe the Fed would like to see that, but would you be concerned?
No, that's when I'd start watching. And I'd be paying attention a little closer to the signals from the Fed, because if they let it tick to 4 and then 4.5 and say, well, we need more data, I'm going to be
yeah. I hear you. Yeah. See, I agree with you there. I think if we do tick above 4%, and the full-time labor market employment percentage, the percent of full-time employed people, I think if that worsens, combined with a higher unemployment rate, I think that is all the Fed needs, because inflation is taking care of itself. So I think that's all the Fed needs to cut one time in September at least. And then they might pause again. You might get another pause to see how the data proliferates thereafter. People think that the Fed doesn't like to, start and stop. And whether or not they like to or not, it doesn't mean they haven't done that in the past. In fact, 1995, which a lot of folks are comparing this year to, by way of the market and what the Fed might do. In 1995, the Fed cut rates for the first time and then paused for another 6 months before they cut rates again. We could see that same thing happen here this year. So I agree. They, watch the data. I'm not terribly concerned about, getting above 4% in the unemployment rate, mainly because I think the labor market is vastly different post-COVID than, the pre-COVID era. And so I wouldn't worry then. I think kind of that SOM rule that everybody throws around and what we've talked about in the past, I think that will become another failed recession signal, assuming the SOM rule triggers at some point later this year. Nonetheless, getting back to our market concentration, I saw this post out there on Friday, last Friday, Brad, from Dean. Dean, I know Dean, good guy, does really good work. I knew him from before he took a job at the Sentiment Trader. He says the percentage of S&P 500 stocks outperforming the S&P 500 over a rolling 21-day period fell to 18%. That's the second lowest point in history. In 1995, when the indicator recorded 1955 recorded the lowest reading ever, General Motors accounted for 10% of the weighting in the S&P. So it's key. Here's the thing. You got to understand what he's talking about here. It's the percent that's outperforming the S&P. Outperforming. It's not the percent of companies or the percent of stocks that are contributing to the S&P 500's overall performance. He's talking about just the stocks that are outperforming, not contributing, but outperforming. And so when I read this and I see kind of this salacious tone here in the chart and what have you, I say to myself, what can I do with this data? Only a few companies, a few percentage of companies are outperforming the S&P 500. So ideally, I want to be in those stocks, but is it too late? And if it is, then I might as well just buy the S&P 500. At the end of the day, there's not a lot of utility in this statistic. And so here's what I want investors to really discern when they see something like this. It's not a matter of how many stocks are contributing. It's a matter of how many stocks are outperforming. And there's really no utility in this. If you're not a good stock picker, this isn't going to make you a good stock picker. It's just going to highlight you're not a good stock picker. That's it. And so I came up with this metaphor. Going back, you remember Michael Jordan, of course, everybody. He's the GOAT, okay? He's the GOAT of all time. He's the greatest NBA player of all time. So I came up with this metaphor. The percentage of NBA players that outperformed Michael Jordan, let's call him the S&P 500. The percentage of NBA players that outperformed Michael Jordan over any rolling 8-year period during his career was 0%. He's the GOAT. Nobody outperformed Michael Jordan. This does not account for the total number of NBA players that contributed to all the points scored during any NBA year during his career. Let that sink in. This is what we're talking about here when you see this kind of data. It just doesn't tell you to do. There's nothing you can do with it. Does this mean because Michael Jordan outperformed over every 8-year period that nobody scored a basket in any year that Michael Jordan was an NBA player? Of course not. It just tells you that nobody outperformed him. There's nothing to do with this. It's just data for the sake of having data. This is what I mean. This chart tells you the percent of S&P 500 companies with positive year-over-year price change, meaning on a year-over-year basis, they're delivering a positive return in contributing to the S&P 500's overall gain. Back in May 17th, it got to 76.8%. So 76.8% of stocks were contributing to the S&P 500's year-over-year gain as of May 17th, which was, by the way, the highest since the decline in 2022. So when people say the market is so concentrated, only a few stocks are carrying the S&P, it's a cap-weighted index. The heavier weights are going to give it the bigger moves, but 76.8% of stocks are actually contributing to the S&P 500's performance. That's not highly concentrated, folks. All right. So as a lot of our members understand, we had raised our price target for the S&P 500 in 2024 back in April when the market was in decline. See, unlike a lot of strategists out there that are raising their S&P 500 price target now, they're kind of chasing the market's performance. We have enough data, where we had enough data going into April that told us the top was not in. When we already achieved our first price target objective of 4,200 in the first half of the year, actually in the first quarter of the year, we had enough data suggesting we needed to adjust our price target regardless of what the market was doing in April, falling below 5,200, falling below 5,100. And so we upwardly revised to 5,400 by year end. Well, wouldn't you know it, folks? Already achieved that as well here in the month of June. So this is just a heads up that once again, we will be looking at our price target objective for not just the full year, but over the next 12 months. And we'll be disseminating that probably in the next couple of weeks. All right, well, let's take a little pause here from the data and what we're looking at here in our, state of the market going into the second half of the year. Is there anything that's kind of on your mind, giving you some cautionary vibes, or even just appreciative vibes of where we are in the market year to date, Brad? Maybe some of the things you're looking at, some of the things that you plan on doing, with your portfolio back half of the year.
I'm looking at laggards.
Mm-hmm.
I'm looking at good companies that are not participating at all or participating very little. And some of them have even lost ground, and you're scratching your head going, why is PayPal trading where it's trading? And you can think of a lot. Verizon. You can think of a lot of companies. And I've concluded it's not that they're dumping PayPal or some of these other companies. It's because, where's the smart money going?
Mm-hmm.
Well, if I'm going to buy some more NVIDIA, I can't afford all this PayPal over here.
Right.
There's a whole lot of that in the market right now. And you see it even more so in the small caps. So I'm just kind of keeping my radar, my antenna up, because this is going to shift again. And when it does, you want to be ready. Having said that, I think we're in the first inning of AI. Seth, don't you agree that most of what we're seeing in AI is just, oh, well, that's kind of cute.
Yeah, yeah.
But that's kind of where we are now. I mean, the stuff that Microsoft is trying to do to your online searches and stuff, I want to say, would you just leave me alone until you get this to where it's really helpful to me?
Right.
So,
I would tend to agree.
And that helps to explain why we've got these handful of stocks that are massive outperformers. Everybody just piling in.
Yeah, it's a trend.
Every time I think SOXL has reached this high, it goes to another one.
Yeah, the semiconductors, the mags. Well, not even. You can't really. I mean, it really is more of a mag 3 now. Your Microsoft, Apple has joined that party with their WWDC conference. And I've been saying this for months on end. When it comes to AI, all roads lead to the iPhone. If you're gonna have, AI and mobile computing together, there's no bigger, more reliable, more secure network and operating system than the iPhone. And wouldn't you know it, it's basically what they announced at the, their worldwide developers conference only a couple weeks ago, and the stock launched. So yeah, I would tend to agree that this is kind of in its infancy stage. And going back to why a lot of folks out there do believe this is more 1995 as opposed to 1999. And so far as, a shift in the market, I do believe there'll be some kind of a catch-up phase here for smaller and mid-cap tier level stocks and indexes. It's just a matter of that trade, coming into vogue. Maybe that to what you had alluded to earlier demands either lower rates or the either by way of treasury yields falling, just because inflation is falling and satisfying high safe haven assets, safe haven asset seekers, bond investors, or it is because the Fed does finally cut rates and triggers whatever algorithms that are coded to send the fund flows, into small, mid cap, equal weight areas of the market. I'm of the opinion that's an inevitability. And to your point, you got to kind of position. If you're early, you're early. That's just part of investing. But I do think that's, ideal positioning for the back half of the year. I'm not suggesting that you get out of tech, you get out of semis, you get out of the AI trade, you get out of the Mag 7, the Qs, the NASDAQ. I'm not suggesting that. I still think as part of, the growth portion of a portfolio, those need to be in there to one degree or another. Having said that, are they overheated, or have they gone Yeah, to some degree, they're definitely overheated. However, you could have said that now for the last 30 days and watch this rip ever higher. Overheated conditions can last, far longer than most people care to consider. So it's not about selling out of everything that's been working. If it's working, it's probably going to continue working, especially if it's growth. But it is about, having some cash that will get dedicated to other areas of the market. So I agree with you wholly there. I like small caps for the second half of the year still. That trade has not worked out. They've been very range bound. They failed to break down, and they have failed to break out basically all year long. And if you think about it, abstractly, isn't that what a coiled spring does? Right?
Yeah.
It coils over time, and eventually all that energy gets expressed. So we'll see if it comes to fruition. Not every investment thesis works, folks. There'll be good ones, there'll be bad ones, and everything in between. But stick with the markets. Amazing rally to new all-time highs in 2024. Now, coming into this year, and a lot of our Finom group members, this chart, this stack chart, if you will, the S&P 500, is nothing new to you. Last year in March and November of last year, we had Zwig breath thrust. And what I highlighted in that fourth quarter of last year is that the only other time that we've seen a calendar year deliver two Zwig breath thrusts was in 1962. The top S&P 500 was from that last breath thrust in 1962, happened in July, the last of two, and the market just basically stormed higher all of 1963. And this, when I first, posted this chart, that was the breath thrust in 2023. And up to, April, basically, it was mirroring the 1963 pattern. And we can fast forward this chart to today. It's still doing the same thing that we did in 1963 after the former dual Zwig breath thrust. Yeah, and people say, well, it's just coincidence. Okay, if that helps you sleep at night. But so far, you just can't deny what's taking place in this analog. But this is another example of how dedicated we are at Finom Group, to looking at all aspects of price action. Underneath the surface, understanding our breath thrust to give us a better indication of the probabilities for the S&P 500 going forward. All right, this is from Charlie Bolello. Through the first 112 trading days of the calendar year, the S&P 500's year-to-date return ranked as the 22nd best, going all the way back to 1933. And again, this was 112. We've gained another 1% since then. So, but back on the 112th day, we were up 12.7%. If we're just, focus on, everything from 12.7%, but below 18%, there was never a negative return the rest of the calendar year. Day 113 to year end, positive. The worst return was 0.9%. So you knew, based on 112 trading days into the calendar year, the probability to gain at least one more percent by the end of the year was 100% probability. And wouldn't you know it, literally this week we did that. We gained another 1% already. 29 all-time highs here this year, but that chart was from last week. If you lifted up the rock this week, we hit 30. We have 30 new all-time highs this calendar year. Now, why is this kind of configuration? There's more data in here than just tracking, which is what we talk about in the trading room, what we disseminate in our macro market research report. Sometimes the data is staring you in the face as to what the S&P 500 can do going forward, simply based on tracking how many times it's achieved an all-time high in any particular calendar year. We're at 30 now, folks. We have 30 all-time highs in 2024. The only other time the S&P 500 stopped at 30 all-time highs in a calendar year was 1983. That was the last time. Every other time it's hit 30, it's delivered at least 2 more new all-time highs. That's a lot of samples, folks. So the probability that the S&P 500 will still go higher this year is about 95%. If I calculate for time and rate of change, that has already occurred this year. There's a 95% probability we'll make at least 2 more new all-time highs. We're making all-time highs in June. This is another piece of data you want to keep stored. Keep this in your back pocket every single year, folks. How often does the S&P 500 peak by month? January, it's peaked 5 times. And this data goes back to 1980. While this only goes back to 1980, it rings true going all the way back to World War II. June, we have never peaked. The market has never peaked in the month of June. But Seth, here we are in the month of June with an all-time high. I know. Based on the fact that we've never peaked before in the month of June, this tells us this is probably not going to be the all-time high for 2024. So we have 2 data points, this here and this here, that tells us more than likely we are not done making new all-time highs in 2024. And I talked a little bit about how a lot of folks believe this is a 1995 setup. The analog, if you look at the price patterns from 1995 and 2024, they look very similar. In 1995, let's see, we made 77 all-time highs, which was the most new all-time highs made in any calendar year. Maybe it is going to be 1995, folks. All I know right now is there is a very low probability that we're making the high of the year right here in June. A very low probability. Now for the NASDAQ, it's a little bit different. NASDAQ, maybe it's going to peak in July. Historically, 25% of NASDAQ 100 peaks have happened in the month of July. Is that a majority or minority? That's a minority. Just because, it's the most out of any month does not mean it's a majority of the peaks happen there. It's still only 24% of the peaks happen in July. It's something to keep an eye on, though, I would say. This is my equivalent to the unemployment rate getting above 4%, Brad. I'll keep an eye on things when, when we get to July. Some notes here from Fundstrat's Tom Lee. I talked about, folks thinking the high is not in. For June, Tom Lee, based on data. Now, folks say, well, if we don't get to 5,500, Tom Lee will be wrong because he said the S&P 500 should hit 5,500 in the month of June. The reality is that's what the data says. The median gain based on the fact that Q1 was a positive return and April was down. Historically, June delivers roughly a 4% return. Based on where we were going into June, you do the math, it gets you to 5,500. Tom Lee didn't say we're getting to 5,500. The data suggested we could get to 5,500. And folks, we've gotten to 5,488. I'm going to say that's close enough to suggest if you had leaned into this data, if you did nothing but buy on the first day of June, you bought the S&P 500 index ETF, you got a positive return. That's how you use this kind of data. It helps you understand the forward probabilities and how to possibly profit from them. But before we even got in May, folks, before we even got in May, we said it's an election year. You do not want to sell in May and go away. These notes here from Bank of America. Don't sell in May. This was a heads up to Finom Group members. June through August has been up 75% of the time since 1928. And the average return is 7.27% in that June through August period. If you think about just those 3 months delivering on average a 7.27% return, and you juxtapose it with the average annual return over the last 20 years for the S&P 500 has been 9% a year. I mean, in just 3 months, you could have made your calendar year returns. Just sticking with the market, knowing the data, the probabilities. The data is the probabilities, folks. You want to align yourself with the greatest probabilities. This is the 4-year cycle composite index from Ned Davis Research. Coming into June, we had the liftoff from May. We never got the downturn in May. It actually happened earlier in April. But the bigger picture here is the July into September period. Historically, this 4-year cycle roadmap has a tremendous liftoff in July. And that's essentially what Goldman Sachs wrote about a little more, I think 2 weeks ago. New quarter, new half year. This is when a wall of money comes into the equity market quickly. In addition, share prices should benefit from strong seasonal trends and rising engagement from retail investors. I am seeing a reemergence in retail traders during the summer. They tend to come around in July. So that pretty much is in lockstep with the 4-year cycle composite index there. How good has the S&P 500 performed in July? I think this chart basically says all you need to see. The last time July delivered a negative return in the S&P, July 2014. July 2014. So we've gone, what's that? Almost 10 years, 9 years. 9 years without a decline in the month of July. What about the technology sector, right? Because tech, that's semiconductors, that's software. Tech has not delivered a negative return in 15 years in the month of July. Look at the return also, 4.6%. Last 15 years, the average return in the month of July for the tech sector, ticker symbol XLK, has been 4.6%. 100% of the time it's been positive. 15 straight years. And that just goes to what happens in July, Brad? What are we dealing with in July? Do you know? You think about the timing around this fundamental event every third quarter.
I think I'm not thinking like you're thinking, so I'm going to say what I'm thinking. And I think this every year, by the way. And usually we're right if we think this way. Nothing has happened.
But in general, that's true.
Well, why that's important is starting sometime in June through most of July, I lean heavily, or I don't want to overstate that, heavier than usual into things like short VXX and UVXY because it usually pays off.
Summer doldrums, lower volatility.
Yeah, that's what's going on. So that's what I mean by nothing. You do have the 4th of July in there, but that's part of the nothing going on in the stock market because people are off on their barbecues.
Exactly. Yep. You have Wall Street basically heads out for their summer vacations. That's why they call it the summer doldrums. You typically do have lighter volatility, but specifically July, earnings season. Earnings season gets into full swing. Think about Apple, Microsoft, Adobe, Broadcom, Nvidia. That's why the tech sector typically delivers outsized returns in the month of July with such a high positivity rate. Absolutely. But it is definitely good to opine over the volatility complex, especially here in an election year. Election year is a little bit different. Election year, you tend to see a liftoff in the summer months when it comes to volatility, which I know our Finom group members are highly anticipating because we are looking for that opportunity, to get some short volatility trades back on the board. Because we know what also happens after the election, which is typically immediately volatility gets crushed again.
Right.
I mean, that trade is, there's gimmies, folks. There's like freebies around the election year, folks. And this is one of those freebies that, typically happens is you get a volatility crush right after the election. So to our earlier point, you want to be early. You want to be early. You want to get positioned. So good stuff. All right. Now, most people saw my X post over the weekend expecting the market to decline this week. I have several, indicators that I have been looking at. They're everything from market breadth, market internals, market structure, exhaustive signals, fund flows, 4-week moving average fund flows, prime brokerage desks that I have, kind of contacts with that, give me a little bit of insight into what their clients are doing, their whales, so to speak. And all of that compiled to suggest that the market would, finally pull back here this week. How much? It doesn't tell me. It doesn't tell me the market will be down 1, 2, 3. It doesn't tell me any of that. It just gives me a directional bias. On top of that, now after I had posted that, about 6 hours later, this quant from Wayne Whaley was published that basically confirmed what everything else I was looking at suggested, which is a pullback in the markets this week, primarily speaking to the S&P 500. This is a quad witching monthly options expiration week, and historically, the June 19th through June 27th period, you saw a decline, a pullback in the markets a majority of the time. So that basically confirmed for me that, the things that I'm looking at are the right things to look at. The good news, however, the good news is that after this time period, June 19 through June 27, the June 27 period to July 23rd, so essentially a calendar trading month, 25 times the market was positive over that next 1 month period. Only 4 times was it down, but it gets even better. The last 14 times the market delivered a positive return. So whatever happens here between June 19 and 27, that's probably an opportunity to reload, re-leverage, buy the dip, because more than likely the next 1 month period, which basically covers July, the market delivers a positive return. And again, this is how you use this kind of data. Seth, if you were projecting, a possible decline, a probable decline here this week, why aren't you selling? Because I want what I have in my portfolio. I like it. I don't want to sell it. I think it has higher prices going forward. There's no guarantee here. This is not 100%. It's a high probability decline. It's not a guaranteed decline. Plus, I've got cash on the sidelines. Hence, re-leveraging, reallocating, buying the dip, because this is the probabilities going forward. And these probabilities are much higher than these probabilities. Any comments there, Brad?
No, I kind of like what you're saying. I might add that June has been a very strong month. So,
yes.
So if you put that in with the data you have there, it just makes sense that if you've made some good winnings, it's time to trim a little bit so that you can reload. And that's what I've been doing since last week. I'm leaning into cash a little bit more. I have less of the TQQ than I've had all year. And therefore it'll probably rocket up further since I sold half of it over the past month. But
and we still have, there's still a lot of time on the clock here for June, but this is also something that I just looked at this morning. So, everybody's kind of getting a sneak peek at how my mind works when it comes to data, and I can kind of feel the market, absent actually, going to past studies and whatnot. Entering, what is this? No, I'm sorry. Let's see. The end of April is what I want to look at. The end of April, year to date, the market was up 5.57% at the end of April. Why is that important? Fast forward, the end of May, we are up 10.64%. That tells me in the month of May, we gained more than 5%. So in 1 month, we gained more than 5%. Fast forward to today. So we were up 10.64%, as you can see off to the left of my screen. Now entering or through June to date, we are up. Look at that 10.64 now. Almost 15%. Let's say we gain another 5% here. So we'll have back-to-back months up 5% each. Do you think I don't have data on that, folks? There's a little teaser maybe for this weekend's macro market research report. But that's how my mind works. I'm always looking at I can kind of feel and remember, and so then I poke around a little bit to see what's what and see what the probabilities are even before we may hit such probabilities, right? Back-to-back months up 5% each month. We'll see. So here's also some quantitative studies I wanted to remind us of. and the why. Like, why are we reviewing quantitative studies that we talked about basically since March or April? This is one of them. The market is still yet without a 2% pullback, right? That was going into April. We still didn't have a 2% pullback for greater than 100 trading days. Well, what this data told us, and so that was basically the end of March. This is a 6-month study. If you've gone 100 trading days without a 2% pullback, 6 months later, the market was up 100% of the time. So how do I use this? How do I use this data? Right? We went into, after we pulled this data, right, March 27th, we went into a 5% pullback. When this triggered, the S&P 500 was at 5248. So I know 6 months later, every single time this has happened before, the market was higher. So all the market had to do is climb over 5248. That 5% pullback that we had in April was opportunity based on the fact that if we project out 6 months, the market should be higher. So you should have been buying, at the very least, the S&P 500 index ETF, the SPY, the spider. Because historically, we had a 100% probability of a positive return on that trade. That's how we use this data. And here's another one. On May 15th, the S&P 500, May 15th, gapped up 1% to make a new all-time high. That actually has happened 13 different times in the last 10 years. 5 of them happened this year alone. It tells you how many gaps are in the chart in case we go down. But every time that's happened, the market has been positive 3 months later. So we start here on May 15th. That's the signal date. What was the S&P 500 trading that day? It was trading 5308. 5308 on May 15th. 3 months later, that'll take us June, July, August. So by August 15th, we should be higher than 5308. So when I tell you that there's not a lot of time for downside, there's probably not a lot of magnitude to the downside either. But let's say we get back below 5308 between now and August 15th. What do you want to be doing? At the very least, just buy the spider. Could this be the time that the one time, the first time doesn't deliver a positive return? Absolutely. I don't deny that. I know that. Doesn't help me. Knowing that doesn't help me. 13 other times you could have said the exact same thing 13 other times and missed out on a great trade. We lean into the higher probabilities. Again, this is how you'd use the data. You don't worry about the one time that it could go awry. That's not discipline. Quantitative analysis is a discipline. The more you lean into the high probabilities, the more times you'll be rewarded. Now, here's another reminder, folks. We were up greater than 10% in the fourth quarter of 2023. We were up greater than 10% in the first quarter of 2024. Back to back, 10% plus quarterly gains. And again, that ended, at least as far as we know now, that ended at 52.54. The S&P 500 was trading at 52.54 at the end of Q1. 12 months forward, historically, this has happened 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times. This has happened 10 times. Every single time, 12 months later, the S&P 500 was higher. Look at the average return, 16.8%. Is this rally going to end in 2024? It could, but the probability suggests not even close. Not even close to ending. By March 31st, we should be higher than 5254 of 2020. March 31st of 2025, we should be higher than the end of the first quarter, which was 5254. Again, not a lot of time, not a lot of magnitude for downside. And this looks very juicy. Told you so, Brad.
Are you talking about the stock market or the Celtics?
Well, I don't know. I mean, congratulations to my Celtics. I mean, I worked very hard at that championship ring, you know. But man, it's been, well, the last championship they won was 2008 when they had the trio, Kevin Garnett, Paul Pierce, and oh gosh, I forgot, Ray Allen.
Yeah.
And yeah, so it's been a long time coming. Been a long
Well, to give you an
time.
idea how awesome the Celtics are, the Mavs, after they did some things at the trade deadline, made themselves a really awesome team. And the deal with the Celtics is they have 5 all-star starters.
Yeah.
You just can't. You just
Every one of them can shoot and hand. It's as if they have 5 guards on the floor at all times.
Yeah.
And a couple of those guards have size.
Yeah.
But yeah, they can, all 5 can shoot. They can all drive to the lane. They all have, you know, good ball handling skills, and they all want to play defense. And that, you know, is a rare, it's a rare find. It's a rare find. But with regards to I told you so, you know, we heard all of this nonsense through the first quarter about the disinflationary cycle reverting and, you know, possibly getting, you know, inflation going up again. And it was maybe in April that we disseminated this chart, this analog that greatly resembled the 1943 through 1949 post-World War II inflation spike. And I said, whoa, 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 folks. First and foremost, in order to get another inflationary bout or spike, you better have an exogenous event, because some 90% of inflation spikes demand and have occurred with an exogenous event. No exogenous event, just stop it. Stop with the financial media nonsense. And
yeah, I still hold that no COVID, no inflation spike. That I think that's
no COVID and no Ukraine-Russia war, because Russia-Ukraine basically just took it to the next level.
Yeah. So
we had the pause, just like we had, you know, in the post-World War II disinflation cycle. You had disinflation, and then it kind of troughed. You had hard comparisons. You had seasonal adjustments, and then it just resumed the disinflationary cycle. And that's basically what we just saw. We had a pause. We hit hard comparisons. We had seasonal adjustments in the first quarter, and wouldn't you know it, you know, May's CPI, we had negative print. We had a negative print in May CPI, for crying out loud. So the disinflation cycle renewed as we thought it would. Some other kind of fundamental or macro fundamental data, because we're hearing all the time that the consumer's tapped out, the consumer's stressed, they're stretched too far, inflation is taking a bite out of their savings. It's garbage. It's all garbage. The Bank of America data, JP Morgan Chase data tells us that. Bank of America Global Research Institute, holy Moses. Whether it's Gen Zers or baby boomers, Gen Xers, all generations have 44% or more deposits than the pre-pandemic period. The consumer's fine. The consumer has more than enough. Look at household deposits, folks. Again, no matter which way you look at it, the consumer's balance sheet is stuffed with cash. If the consumer decides that they don't want to spend on, goods or services or dining out or movies or whatever, it's a choice. It's not because there's a have to. There's no force factor here. They have plenty of cash. There's no comparison to the pre-pandemic era. But you wouldn't know this by all the nonsense that they talk about on CNBC and the like. And here's our chasers. And this, we'll wrap up our, state of the market going into the second half of the year. You got Evercore ISI raising their S&P 500 year-end price target to 6,000. You got Goldman Sachs recently raising theirs to 5,600. They say it could even go to 5,900. If there's a catch-up trade that gets like equal weight S&P up to an 18 times multiple, then you could see 5,900 by year end. I'm not going to give away my price target, top of mind thoughts right now. You guys will see it in a couple of weeks. But this is, again, how they get there. 5,900 in a catch-up trade. Baseline is 5,600 now. If the mega caps just keep doing what they're doing, 6,300. If there's a catch down because all of a sudden mega caps break apart, could go all the way down to 4,800 by year end. And this is what I was referencing all along regarding the 1995 versus 2024 analog. Looks pretty darn similar. Pretty darn similar. All right, any last thoughts, Brad, for our Finom group members and the general public? Anything you want to end with, and maybe I'll give my final thoughts.
Only that I started to bring up something today, and I thought, no, let's wait. But we need to do this one more time before we get into that sort of August, September, early October window. If you remember, we just got swatted last year.
Yeah.
And I suspect we're not going to have that degree this year for several reasons, but you usually look for something in that period, things to ease off, pull back a little bit. But I think it'd be better for us to kind of get into that when it gets a little closer.
Now, each pre-election, so in October, going into the election, each one since 2012 has delivered a minimum of a 4.5% pullback.
Yeah.
I think the maximum was a little over 7%.
What did we get last year?
Last year wasn't an election year, but we had a 10% pullback.
Yeah, it was big. Yeah.
From August through, we troughed October 27, a 10%. That was a full correction. It was almost 14% in the NASDAQ.
Mm-hmm.
So, yeah. But yeah, it's something to remember. Election year, each one since 2012, you've had each one since 2008, but 2008 was great financial crisis. Of course, we had to pull back. We were just in an ongoing recession there. So each of the last 4 presidential election cycles, you've had a good pullback in the month of October leading into the election. Mm-hmm. The 2012 and 2016, both of those, that was it. That was the trough. Immediately after the election, it was up and away. 2020, we had some residual, but within a week, the market lifted off again in 2020. Yeah. Yeah, something definitely to be aware of. And again, that volatility should show up this election year as well. And in my opinion, it's something to take advantage of, not be fearful of. So with that, I hope everybody has a great second half of the trading year. If you're not a member of Finom Group, you should really consider subscribing so that you have all of this data that we deliver week in and week out at your fingertips. It's like the encyclopedia of quantitative analysis here at Finom Group. Take care, everybody.